Hello everyone, I'm Ravindra Rao from Kotak Securities Commodity Research Desk, and I welcome you all to this fresh edition of Commodities Weekly Roundup. Investor sentiment remained fragile last week as banking crisis spread from US to Europe, sparking fears of a contagion in the global financial markets. Even a massive rescue for the banking sector failed to calm investor nerves. US Treasury yields extended their slide and oil prices fell to a 15-month low. The shift in short term interest rates last week was unlike anything seen for more than 4 decades. US 2 year Treasury yields plunged from a 15-year high of 5.08% notched on 9th March to a 7-month low of 3.72% on 15th March. That's a fall of whooping 136 basis points in a span of just 5 days. The 1 day drop in 2 year yields on Monday was the biggest since the Volcker era in early 1980s. Investors flocked to safe haven assets, taking COMEX gold prices above the Feb highs, whereas COMEX gold active futures contract breached the all-time highs and closed above 59,000 per 10 grams for the first time ever. Safe haven buying also supported the US dollar that recovered from below 104 level, reaching as high as 105. However, the greenback closed the week 0.7% lower, pulling back below 104 in line with the lower treasury yields. On looming fears of a recession and banking turmoil, um, on the price action front, US dollar index may continue to remain weak until it is below 105.60, and this we have been reiterating since past few weeks because it is not sustaining above 105.60. Immediate support is near 103.50. Below that, it might move towards 102.60, followed by 102. Coming to precious metals, COMEX gold prices gained for a third consecutive week as the global banking turmoil that started in the US stoked fears of a broader weakness in the world economy, driving investors to hedge with the safe haven metal. Gold prices witnessed a largest 1 week rally since early 2020. Silver futures closed above the dollar 22.50 per ounce mark, close to levels last seen in February 2022. This was supported by a weaker dollar and concerns that a recent financial turmoil is far from over. The precious metals started the week on a positive note as investors rushed for safe haven assets amid signs of failure of Silicon Valley Bank in the US after the bank took steps to shore up its capital position. The failure of SVB also gave rise to speculation that Fed might go for a smaller 25 basis point rate hike in the upcoming FOMC meeting from the previous expectation of a 50 basis point hike. More events unfolded. Now that raised concerns of a financial contagion into the broader economy. The aftermath of a fastest rate hike in US for decades. Gold, often seen as a safe haven during times of economic stress, has been one of the biggest beneficiaries of this turmoil. US inflation data mostly turned out to be a non-event. The annual inflation rate in the US slowed to 6% in February 2023, the lowest since September 2021. Still, core inflation remained at elevated levels and came in at 5.5% compared with 5.6% in January. March US consumer sentiment fell for the first time in 4 months. The recent emergency measures reversed around half of the balance sheet shrinkage that Fed has achieved since it began the QT in June last year. Banks borrowed a combined $164.8 billion from two Federal Reserve backstop facilities for the week ended 15th March, according to the data published by the Fed. The prior all-time high was around $111 billion, reached during the 2008 financial crisis. Lending by FDIC totaled $142.8 billion, taking the toll above $300 billion. Elsewhere, holdings in SPDR Gold ETF rose from 901.4 tons as on 10th March to 914.72 tons as on 16th March, an increase of 1.5%. During the March policy meeting, ECB hiked rates by 50 basis points, further pushing borrowing costs to highest level since late 2008, despite current financial market instability. The move by ECB have also raised expectation for a 25 basis point rate hike by Fed in this week's FOMC meet. Such a move is also warranted for now, as Fed suddenly abandoning the fight against inflation and changing the rhetoric might add to more market uncertainty, affecting the credibility. Having said that, we are nearing an end to the rate hikes in this cycle, and history has always proven that gold rises with Fed cutting down on rates. On the price action front, COMEX Gold has penetrated an inverse HNS shoulder, inverse HNS pattern, and it has closed above the neckline. However, it has to close above $19.89 per ounce for the inverse HNS to get confirmed. And if that happens, the upside might extend above the previous highs of 2070, and it might go up till 2100 to 2120, which is a trend line resistance. And if it sustains above that, we might see much higher prices because of the inverse HNS break and the trend line break. In case of MCX Gold has been trading above 59,000 for the first time, and it took a it witnessed a throwback in the previous few sessions, but then we have seen a sharp move up, resuming the uptrend. Immediate resistance is near psychological 60,000, and if that is taken out, we might even see prices going higher above 62,000. And there is a ascending triangle breakout, and as per the ascending triangle breakout, the target comes much higher, close to 65,000 to 67,000. But these are long-term views, medium to long-term views. But the pattern breakout is very strong in both COMEX as well as MCX Gold. In case of silver, silver has moved above $22 and is close to $22.50 now. But as we have been mentioning earlier, also it has to move above $24 to $25 an ounce, which is channel resistance. And if that happens, we might see a sharp up move in silver prices. On the MCX, similarly, it has to go above 72,000 on a closing for it to sustain on the higher side. The immediate target comes close to 70,000 to 72,000, but it has to sustain above that for the prices to move higher towards 82,000. Now, global risk aversion has took the sheen of crude oil and base metals. Oil prices slipped to lowest since December 2021 and closed the week with downside of nearly 13%, its worst weekly performance since August 2022. Apart from macroeconomic concerns, oil prices were hurt further as both OPEC and IEA signaled an oil market surplus, while reiterating that Chinese demand recovery may counter weaker consumption from some Western markets. Meanwhile, investors are watching closely for any potential response to the rout from OPEC Plus, with representatives from Saudi Arabia and Russia reportedly discussing efforts to promote market balance and stability. LME copper and aluminium plunged to $8440 per ton and $2233 per ton respectively, both lowest since January 2023, while zinc slipped to 4-month lows of $2,818 per ton amid global risk of sentiments. Besides, China Parliament authorities' intention to maintain stability and credibility in order to boost investor confidence did not elicit a major market reaction. Technically, WTI crude has a good support on weekly charts near $65, which is a 252-day moving average. Until it is held by the bulls, we don't expect the prices to slide further lower. $65 should act as a good support, and on the higher side, $72 was the earlier support, which has now become the resistance. So that would act as a resistance now. So we expect the price to trade between $65 to $72 from a short-term perspective. In case of copper on the MCX, 741, 742 would act as a good support. Until that is held, we expect a range bound movement between 742 to 762. Breakout on either side might give a direction. So a break above 762 on a closing might take it higher towards 775, 780. Similarly, a break below 741, 742 on a closing might pull it further lower towards 713 to 720. Well, to conclude, the focus will now shift to the FOMC meeting this week. Contracts for Fed funds futures show a 61.3% probability that Fed will raise rates by 25 basis points. According to the CME Fed Watch tool, futures also show the Fed will cut rates by July in sign recession fears are mounting as the US central bank tightens monetary policy to fight high inflation. Also, investors remain divided on the Bank of England's policy decision, while flash PMI figures will be closely watched for earlier signs of economic activity in major global nations in February. Well, with that, I come to an end to this weekly podcast. Keep a watch on the precious metals as we might see a good bull run if the banking crisis escalate. All the best. Trade safe.